let us now progress to our fourth session or corporate taxation. To take this forward, we have N Dwaraknath partner, Pricewaterhouse. Dwarak leads the corporate and international tax practice and who has over 23 years of experience in advising clients on international taxation and transfer pricing across various industries. He has expertise in advising multinational companies on Indian acquisition and operations, including tax incentives, contract, IP arrangements, and tax optimization strategies. He has a strong track record leading cross-border teams on complex projects such as business restructuring, investment restructuring, and value chain analysis. Alongside him is Tapan Gupta, partner at Pricewaterhouse. Tapan is a partner in the TRS line of service, working in corporate and international tax and merger and acquisition practices. With over 20 years of experience in corporate tax, he has extensive expertise in transfer pricing and M&A. He has advised numerous domestic and multinational companies on tax matters in India and abroad. A cordial welcome to you both.
Thank you. Thank you, Ridhima.
So the session is now yours to lead. Please take it forward.
Thank you very much, Ridhima. And good afternoon to everyone. I hope you're able to hear me clearly.
Yeah, yes.
Great. So I think as
the slide, Dwarak.
Yeah, sure, Tapan. Thank you. So as the previous speaker was saying, she was struggling to extend the session to 45 minutes because of very few changes. I think in general, the reaction from the community has been that the budget has represented stability more than anything else. And the number of changes are a few and not too many.
Are you able to see?
I think you'll have to switch to the slides, Tapan. I'm able to see the screen, not the slides.
1 second.
Sure.
I'm not able to see myself actually.
Okay, let me just see if I can do it. Do you want to just stop sharing and I'll just see if I can share my screen. Yeah. I hope you can see my screen.
Yeah, I can see.
Okay, wonderful. So I'll control the slides, no problem. Yeah. So as I was saying, I think the overarching message from the budget has been one more of stability and continuity. And if you listen to the finance minister's speech on the 1st of February, there were 4 broad themes that she set out. The first was continuity and stability. The second was to promote entrepreneurship. The third was to widen the tax base and provide certainty to taxpayers. And the fourth was to focus on the compliance aspects. Now, when you just take a step back, let's try to understand what the government's thinking has been. For any investor, whether it's a domestic investor or a foreign investor, perhaps the most important thing that they look at is for stability. And that is not only in the taxing system, but also in the political system that exists and the economic structures that exist within the society. And they look for certainty. And with that view in mind, there has been no change in the tax rates that have been proposed in this year, which is a sign of the stability that the government wants to put. Similarly, there has been a great emphasis on rationalizing several laws and reducing the overall compliance burdens of taxpayers. That is not necessarily limited to taxation, but across various statutes which would apply to corporations which are operating in India. From an entrepreneurship standpoint, there was a recognition that startups continue to be a very important part of our economy and our growth. There have been some amendments which we will talk about, some of them which help startups, some of them which may not help startups that much. There has been an impetus for MSMEs by ensuring that their cash flow is bettered through the 43B amendments, which allow for deductions only on actual payment basis, and the concessional rate of 15%, which has been extended to cooperative societies which are formed. In terms of clarity which has been provided, there are several areas which required clarification, which taxpayers had asked for. One was in respect of market-linked debentures to bring that in line with equities. the cost of acquisition or improvement for self-generated intangible assets, and there has been clarification which has been issued in regard to that in the budget proposals. Treatment for online gaming is something which has been introduced. Last year, it was the treatment of VDAs. I think this year, recognizing that online gaming is the next thing which has caught on, the government has brought in clarity on that. There has been clarity which has been provided with regard to 194R and Section 28, the aspect of whether cash benefits can be treated as taxable income as well, requiring deduction, and also in the context of business trusts. And we will discuss all these in greater detail as we go through this presentation. From a compliance standpoint, the appointment of 100 new joint commissioners to help with the disposal of appeals is definitely a very strong positive message that the government has sought to put forward. They've increased the threshold for small businesses and professionals for presumptive taxation, which is again a good move. They have brought in some amendments to Section 10AA, which bring it in line with the old Section 10A in order to ensure that certain conditions are met for taxpayers to claim those benefits. They've also empowered the revenue to carry out inventory valuations or to request for inventory valuations in the course of assessment proceedings. Some of the timelines for assessments have been rationalized. And finally, as you would have already heard, the personal income tax regime has been liberalized to some extent. So overall, it does appear that the government is serious about sending a very strong message to investors, which is focused on stability and continuity, on providing clarity and certainty to them, and at the same time ensuring that compliance aspects are met. So with that, maybe I will pass it on to Tapan to take us through some of the amendments in greater detail.
Thank you, Dwarak. So as Dwarak mentioned, obviously there were quite a few changes, etc., which are there. But what we will do is that we'll cover some of the key changes which we thought would be relevant. So I'll start with the same theme that Dwarak mentioned, which is promoting entrepreneurship. And the first thing that is there is on the startup taxation. So what happens generally in a normal scenario, if let's say there is a loss in a company in year 1, and there's a profit in, let's say, year 3, and there's a requirement to brought forward this loss and adjust that loss against the profit. That is possible only if the shareholding continues at 51% at the year in the end of the year in which the loss was incurred, and in the year when you are trying to set off that loss. Now there is an exception to that from a startup perspective, is that this condition is relaxed in the case of startup, is that even if there's a change in shareholding beyond 51% for the first 7 years, then still you are able to do the set off. Now this 7 years has been extended to 10 years now. So within 10 years period, even if there's a change in shareholding beyond 51% voting right, still the carry forward of loss and set off would be permissible. The only thing that needs to be considered is that the shareholding should continue throughout the period, which means that the shareholders who were holding shares with voting rights should continue to be the shareholders in the year in which the set off is being taken for the losses. So the change is that from 7 years, it has been extended to 10 years now. So within the 10 years period, that benefit can be availed. The second thing which has happened is that for the purpose of taking the tax exemption under 80IAC, a startup was required. The startup was required to basically incorporate before 31st March 2023. That has been extended for 1 more year. Now, if the startup is registered incorporated before 31st March 2024, the benefit of 80IAC, which is basically tax holiday for a period of 3 years out of 10 years, would be eligible. Second is on the MSME front. It's not MSME per se, it is only micro and small, not medium enterprises. So for the purpose of payment to micro and small enterprises, that has been covered under 43B now. So within the time limit provided under the MSME Development Act, which basically states a default period of 10 days, unless you negotiate a separate term, credit term, which cannot be beyond 45 days. So if the payment is within that period, then it will be allowed. If it is not within that period, then the deduction will be allowed only on payment basis. So uh, take an example. Let's say as of 31st March, there's a provision which has been made, and as per the negotiated term, the payment has to be made within 30 days. So even if the payment is made within 30th April, the deduction will be allowed for the previous year ending 31st March. But if it is paid beyond 30th April, then the deduction would be allowed only in subsequent year. So in 2019, there was for the purpose of uh, companies who are engaged, who start up a new manufacturing entity, there was a section which was introduced, section 115 BAB, which basically stated that if there's a new company which has been set up after 1st of October 2019 and before 31st March 2024, then they would be able to get a concessional tax rate of 15%. Okay. Now this was only there limited to companies. Now this has been extended to cooperative societies as well. So any cooperative society which is set up after 31st March 2023 and starts operation before 31st March 2024 would be able to get this 15% concessional tax rate, and all the conditions which are there for those new companies, exactly this section which has been introduced, 115 BAE, exact same conditions apply, which means that it should only be into manufacturing. There should be no other operations. Incidental income, if any, will be liable to 22% tax without deduction. Related party transaction, if any, would have to be arm's length. If the transaction is beyond arm's length, that the differential amount will be subject to 30% tax. And AMT provision, like in companies you do not have MAT for 115 BAB. Similarly, for cooperative societies, there won't be any AMT once they opt for this 115 BAE deduction uh, concessional rate. Yeah. Now, from a tax certainty and widening of tax base perspective, there have been quite a few changes which is there. I'll cover that one by one. First is with respect to market-linked debentures. Now, what was happening is that with respect to market-linked debentures which are listed in a stock exchange, uh, any transfer, any gain arising out of that market-linked debentures, if it was held for more than 1 year, it was considered as long-term capital gain and subject to tax at the rate of 10%. So the government felt that there was a lot of leverage happening, which the income which probably would have been subject to tax at normal rate as interest is basically getting a beneficial rate of 10% because of this long-term capital gains position. So the change which has been proposed is that the new section has been introduced, 50AA, and it has been proposed that any amount which is received on account of transfer or redemption of market-linked debentures will be subject to a short-term, will be treated as a short-term capital gain and would be subject to a normal tax rate. The second thing which has happened is that with respect to, again, listed securities, Section 193 provides for a withholding tax of 10%, but for listed securities, there was a carve-out or exemption which was provided for this withholding tax. Now that exemption has been withdrawn, so any interest which is paid for listed securities like debentures, bonds, etc., will be subject to Section 193 and a withholding tax would apply. There's a change with respect to the treatment of, in respect of transfer of intangible assets. As you know that many of the intangible assets in the nature of goodwill, right to carry business, etc., are basically, as per Section 55, it's mentioned that the cost of acquisition would be nil or the cost of improvement for those assets would be nil. But beyond that, also there were various other intangible assets which were not covered under Section 55, were not defined that the cost would be nil. People were taking positions that because the cost cannot be determined for those, and it is not provided under section 55 what is the cost. And therefore, taking the benefit of the Supreme Court ruling in BC Srinivasa Setti, it say that the capital gain cannot be computed, and therefore there cannot be any tax. So in order to overcome that, now what has been provided, that if there is, for any intangible asset or other right, etc., by whatever name called, the cost of acquisition will be considered as nil. And for those assets also, the cost of improvement will be considered as nil. And therefore, in those situations, if there is a transfer, now the capital gain can be computed because the cost would be deemed at nil, and the entire will be subject to capital gains tax. Yeah. Winning from online gaming, as this online gaming was is covered any which ways under section 115BB. But what the government has done, that considering that this particular sector is actually growing, they wanted to carve out that from that section and introduce a new section called 115BBJ. And what has been proposed is that any winning from online gaming, net winnings, would be subject to a 30% tax. The method of computation, etc., will be prescribed. So most likely it will be whatever winning, what minus, or whatever is the subscription charges, etc. Probably that kind of computation will be prescribed. So any net winnings will be charged to tax at the rate of 30%. Similarly, with respect to withholding tax also, there is a separate section which has been provided, which is applicable from 1st July 2023. There is already a section which is there, 194B, which covers this, but given that there's a separate section for the purpose of tax computation, a separate withholding tax section provision has also been proposed, which is 194BA, where the withholding tax will be at the rate of 30% again on net income. So when the payment happens, at that point in time, the net income will be determined and the withholding tax has to happen. If there is no payment which is happening within the year, then as of 31st March, whatever is the accrual on that, withholding tax would happen at the rate of 30%. And now, and obviously it would be beyond 10,000 rupees. So up to 10,000 rupees overall in a year, there won't be withholding tax. Beyond 10,000 rupees, this 30% withholding tax would apply. With respect to 194 LCLD, there is no proposed amendment as such, but there was under 194 LCLD where there is a ECB or interest on foreign exchange bond or rupee denominated bond, etc. There was a concessional withholding tax rate of 5%, which is provided those loan, bond, or loan or bond or etc. is issued prior to July 1, 2023. So that cutoff date of July 1, 2023 has not been extended, which means that any ECB, any bond, infrastructure bond, long-term bond, or rupee denominated bond, etc., which is issued after July 1, 2023 will not get the benefit of concessional tax rate of 5%. Similarly, for 194 LD, with respect to income from securities of FII, etc., where the withholding tax was 5%. Now, after July 1, 2023, the withholding, that concessional rate of 5% will not be applicable. So the government has not extended this July 1, 2023 timeline. The next is with respect to profit and gains from business. So 28(4) section says that any benefit or perquisite arising from business or exercise of profession would be subject to tax under business and income from business profession. Now there are rulings, including Supreme Court ruling, which suggested that this section should apply only if the benefit is in kind and not in cash. So what has been proposed is that that any benefit now going forward, whether it is in cash or in kind or partly in cash in kind, will now get covered under 28(4). Similarly, 194, they have also clarified that 194 provides for withholding tax when a payment is made which is in the nature of benefit or perquisite arising from business or profession. It basically says that if the payment is beyond 20,000 in a year, then there's a withholding tax of 10% which has to be done. Now, there was clarification, the way the section read, there was this interpretation that this 194R should not apply in a cash benefit or perquisite, but there were circulars which were issued last year in July and August that even for cash it would apply. So that circular basically now has been proposed to be introduced in section 194R itself, giving clarity that even for cash payments, the withholding tax has to be done under 194R. Yeah. Okay. So there's some amendment with respect to the REIT and InvIT. The way the taxation of REIT and InvIT works is that there is between REIT and the unit holders, there should not be double taxation. So whatever is taxed in the hands of the REIT or InvIT, when it is distributed, is no longer taxable in the hands of unit holders. And similarly, whatever is exempt in the hands of REIT and InvIT is subject to tax in the hands of unit holders. So any distribution of interest, dividend, and rent. So let's say the REIT has investment in SPV, and the SPV distributes dividend or pays interest to the REIT, which in turn is distributed to the unit holders. It is taxed in the hands of the unit holders as dividend or interest. Similarly, if the REIT itself owns real estate and earns rental income, that rental income is not taxable in the hands of REIT. And when it is distributed in the hands of unit holders, it is taxable in the hands of unit holders. And there is a withholding tax mechanism also which is provided. Now, what was happening is that in case of the REIT having made investment in the SPV by way of loan, if that loan was getting repaid by the SPV to the REIT, and that loan was distributed to the unit holders, the position that was being taken is that it is refund of loan, etc., and therefore not subject to tax in the hands of the unit holder. So business trust, which is REIT, was not paying taxes with respect to the refund of loan, and there was no tax which was being paid in the hands by the unit holders as well. So there was double non-taxation which was happening, which is classically the case that was there with respect to the dividend stripping type of scenario. So you get the money and not paying taxes, the value of the unit comes down, you can transfer and have losses. So obviously the government saw this and they wanted to plug this loophole. And what they have now proposed is that any amount which is not taxable in the hands of REIT whenever it is distributed will be liable to tax in the hands of the unit holder, which means that in the scenario where you get a loan, that loan is distributed to the unit holder by the REIT, it will get taxed in the hands of unit holder as income from other sources. But if the but if this is by way of redemption of unit, then the unit holder will be able to get a deduction against the cost of acquisition of the unit. There is a change with in section 5627B. 5627B basically provides that if there is issuance of shares by a company, which is an unlisted company, and the shares are issued at a price which is more than the fair market value, the differential amount is liable to tax in the hands of the issuer company. There's a carve out which is there, which is with respect to money coming from a VC or the shares issued by a startup. Now, this was not applicable with respect to any issuance of shares to non-resident. So it was applicable only with respect to issuance of shares to a resident. Now what has been proposed is that the carve out which is there for non-resident has been removed, which means that any company now receiving issuing shares to a resident or a non-resident, barring the carve out that I mentioned, which is basically VC or real startup, in that case the differential amount will be liable to tax. Now the issue is with respect to the non-resident is that if you look from a FEMA perspective, the shares has to be issued at not less than fair market value. While from a 5627B, if it is issued at more than fair market value, it will be subject to tax, which means that it has to be issued exactly at the fair market value. Otherwise, it will fall foul of either FEMA or there will be taxation in the hands of the issuer company under 5627B. So that becomes a very tricky situation. And for startups which are basically not registered as a startup, in that sense, not having the startup certificate, for them also fair market value becomes a very tricky situation, because normally it's very difficult to determine what a fair market value of a startup would be. It is sometimes more of a negotiated value between the subscriber and the issuer company, and therefore that becomes a challenge, whether somebody can argue that whatever is the value at which independent first timer subscriber is subscribing to the startup, because it's a transaction between two unrelated parties and therefore it is supposed to be arm's length and fair market value, etc., is something will have to be evaluated, and I'm sure there will be a lot of litigation surrounding this going forward. So there is one change with respect to TDS credit. Now, from a law perspective, the year in which the income is offered to tax, the corresponding credit should be claimed in that particular year. But practically, what has been seen is that in many cases there are mismatches where somebody is accounting for income on an accrual basis, whereas basically the payer is deducting at a later point in time. But practically, what we have seen generally is that as long as the taxpayer is able to justify, let's say he is claiming in subsequent year the credit, although the income has been offered in earlier year, as long he was able to justify that the income has been offered to tax, not in this year, but in any of the earlier year, uh, sometimes the tax authorities were allowing credit, and sometimes obviously if the courts etc were allowing credit, saying that at the end of the day the tax has been paid, the income has been offered to tax, and therefore credit should be allowed even if not in that year but in subsequent year. Now the change which is proposed is that now if there is a TDS which happens in a subsequent year where the income has been offered in a prior year, then you need to make an application to ask the department to allow the credit in the year concerned where the income has been offered to tax, and that application has to be made within 2 years from the end of the year in which the TDS has actually been done. Obviously this would create a lot of uh, issues as to how do you map, and a lot of data etc would have to be maintained to in order to claim those withholding tax credit which was generally being credited in the year when actual TDS was being done. The other aspect is that uh, now they would not allow a credit which was being allowed earlier from a practical standpoint. TDS which is pertaining to earlier will not be allowed anymore in the year in which the TDS is actually done. So that's the change which needs to be looked at, and it's an important, very important change from a taxpayer perspective. Again, from an interest perspective, 244A interest will be allowed with respect to that credit, but it will be only from the period from which the claim is made till the time the refund is actually allowed. there's a change with respect to the presumptive taxation under 44BB and 44BBB, which applies to non-resident. And the section basically with respect to non-resident who are into business of mineral oil exploration or turnkey power projects, etc., they have the option to offer to tax on a presumptive basis. So 10% of the receipt, they can offer it to tax, saying that 10% of the receipt is income and pay tax on that 10% of the receipt. So what was happening is that this presumptive tax was optional, and what the non-residents were doing in many cases is that wherever the profit was more, they were offering at presumptive basis. Wherever there were losses, etc., they were not using the presumptive basis and actually doing on an actual basis. And that loss was being carried forward to subsequent year. And in that year, let's say they are offering on presumptive basis, the losses are being adjusted against the 10% presumptive income, and the taxes were being discharged that way. So what has been proposed now is that this switching, if you are doing, then the losses, etc., which is there, which you want to carry forward and set off against the presumptive income, will no longer be allowed. So you have to pay tax on the presumptive basis. No brought forward loss can be allowed and adjusted against the presumptive income. The only limited point that needs to be looked at, which is again not very clear, is that again in subsequent year, let's say year one, you have done actual basis, there was a loss. Year two, presumptive basis, and therefore loss is not allowed to be carried forward and adjusted. Year three, again you do actual basis, whether the loss which was there in year one will be allowed to be adjusted against the profit that you're reporting in year three on a non-presumptive basis is something not very clear, which probably requires some clarity. Yeah. Moving to the theme of focus on compliances, uh, uh, what has been, so we have seen that there are a lot of CIT appeals, etc., which are under faceless. They are pending. Disposals are not happening for last couple of years, and the government also has recognized that aspect. So what they have proposed now is that they would set up joint commissioner of income tax appeals or additional commissioner of income tax appeals, and they would be entitled to dispose of the matters which are emanating from assessment, etc., which could have been done by CIT appeal. The only limited point is that any order passed by JCIT or authority above JCIT, those would not come under this. But any order passed below JCIT will JCIT would have the power to adjudicate on that, and there will be rules, etc., which will be defined, which are the kind of cases which will come, how the faceless, etc., will work. So those scheme, etc., will be provided later on. There's a again relaxation with respect to uh, the deemed income or the presumptive basis income, which is there for certain small businessmen or professionals covered under 44 AD or ADA, which basically as of today says that if you have a turnover of less than 2 CR, then you can go under presumptive basis for business, and the 8% of that would be considered as the income, and if it is realized in check, etc., 6% would be considered as a deemed income, and tax can be paid on that. Similarly, for services also, if the gross receipts is less than 50 lakh rupees, 50% can be considered on presumptive basis as the income, and taxes can be paid on that. So this threshold of 2 CR for business and 50 lakhs for professional services has been extended for to 3 crores for business and 75 lakh for services, but with a rider that this extended the 3 crores and the 75 lakhs limit would apply only if the total turnover or receipts, 95% of that is other than by way of cash. So it should be check, etc. So the cash component should not be more than 5% of the total turnover or gross receipts. Moving to SEZ, as Dwarak was mentioning that obviously there were certain conditions which were there for 10A, 10B, STPI, EOU, etc. Some of those conditions was not there for SEZ unit, which is that the claim is possible only if you are filing the return within the due date, or the sale proceeds, etc., is realized in foreign exchange within a period of 6 months from the end of the financial year, or the period as may be allowed by the RBI. So this condition was not there for 10AA. These conditions have now been introduced from 24-25 onwards, which is the current financial year, next assessment year. And so going forward, SEZ unit wanting to claim tax holiday would have to file their return within the due date and would have to get the money within the prescribed timeline. If the money is received thereafter, then there is a provision under 155 for rectification of the earlier order to get the extended benefit. Like special audit, a similar thing has been introduced, not special audit completely in that sense, but the government believes that on account of the valuation of inventory, there are assessees who are deferring the income to subsequent year. So what they have proposed that in certain situations, if the tax authorities believe that there is a requirement to get an inventory valuation done, then they can refer to a cost accountant nominated by PCCIT, and then the cost accountant will give a valuation report which will be taken into consideration for the assessment purposes. The next is with respect to withholding of refund. So there's a section 241A, which basically states that if the tax authorities believe that in the interest of revenue, a refund which is due for a particular year has to be withheld. If there is, let's say, open assessment, etc., pending, they can withhold the refund. Similarly, there's section 245, which says that if there is a refund which is due and there is a demand which is due for any other year, the refund for 1 year can be adjusted against the demand for the other year. So what has been proposed now is this 241A is merged with 245. Now, which from our reading gives the impression that, let's say, if there is a refund which is due and there is a open assessment which is there for any other year, and the tax authorities believe that that can result into refund demand, etc., in future, and they believe that in the interest of revenue, that refund should be withheld, they now have the power to withhold that refund, even if it is with respect to a likely demand which can be there for any other assessment year. Business reorganization, there is a proposed amendment which is so earlier they have proposed an amendment that in case of merger, etc., where the return has already been filed, the successor entity can file a modified return or an updated return, giving effect to the merger, and that return has to be filed within 6 months from the end of the month when the merger order is received from the tribunal or the court. But there was no provision with respect to how the assessment, reassessment, etc. would have to happen for that. Now they have basically introduced that for those cases where the return has been, the updated or modified return has been filed, they have provided the mechanism for assessment, reassessment of all those returns. There has been change in timeline for certain assessments, compliance, etc. The regular assessment proceeding, which currently provided that the assessment has to be completed within 9 months from the end of the financial year, plus 12 months in case it is referred to TPO, is now extended to 12 months. So going forward, it will have a 12-month period as against a 9-month period, plus 12 months for TP. In case of updated return, which was introduced last year under 139(8)(a), the people can file an updated return within 2 years from the end of financial year. In those cases also, the return was required to be assessed within 9 months from the end of the financial year in which the return was furnished. Now that has also been extended to 12 months. Time limit for submitting TP documentation, which was there, that has to be submitted once you get a notice within 30 days, or further period of 30 days as may be extended. Now that has changed. It is now proposed that it has to be submitted within 10 days, and a further period of not exceeding 30 days can be provided. So within 10 plus 40 days, if the extended timeline is provided, the TP documentation would have to be submitted. Otherwise, it will be deemed that there is no TP documentation, and there could be penalty under Section 270, which is 2% of the international transaction. With respect to return to be filed, once a notice is issued under 148, there was no specific period which was there provided under the law. Now it has been mentioned that it has to be submitted within 3 months from the end of the month in which the notice is received, or such extended timeline. And if the return is not filed within that period, then it would be considered as return has not been filed under Section 139. Coming to personal taxes, now obviously there's a lot of push from the government. The government wants that people actually move to this new personal tax regime, which is provided under 115 BAC. It was there for 2 years, but there was not much traction under this. Now they have tried to make it more attractive, and the government believes that with this changed slab rates, which is there, there should be more and more people taking this benefit and going under this regime. Now, this regime has been made a default regime, which means that this is automatic unless you choose the old regime. The slab rate you can see on the screen, it is far more liberal than what it was there earlier. The exemption, which is there up to 7 lakhs, there won't be any tax because of 87A deduction, which is a rebate which is provided. Standard deduction is also there now. Earlier it was not there. 50,000 rupees standard deduction. So for salaried people, effectively till 7,50,000, there is no tax. For high net worth individuals, the highest surcharge was 37% if the income was beyond 5 crores. Now, for under the new tax regime, the highest surcharge is 24%. So if it is beyond 2 crores, 25%, and that remains. So there is no 37% surcharge for HNIs, which means for them the effective tax rate comes down from around 43% to around 39%. So with this, the expectation of the government that at least 50% of the SSC which are having an income below 15 lakh rupees or in a higher tax slab likely to move under the new tax regime. Some other changes from a personal tax perspective, gifts which was paid by a resident to a non-resident was subject to tax. It was considered as deemed to accrue or arise in India if the gift was beyond 50,000. But there was nothing which was there from a RNOR perspective, and people were taking position that obviously if the gift is given by a resident to an RNOR, that would not get taxed. Now, Section 9 has been amended to provide that if the gift is given by a resident to an RNOR, it will be deemed to accrue or arise in India and liable to tax. Insurance, there is a change with respect to the exemption that you get when the insurance that you buy, when the maturity of insurance happens, then that insurance is not taxed under 1010D. Now, there were changes earlier year, which basically said that the insurance where the premium is more than 10% of the sum assured, in those kind of insurance, though, that exemption on account of receipt on account of maturity will not be there. Similarly, with respect to ULIP also, there was changes that if the premium is more than 2,50,000 per year, that exemption will not be available. Now they have made one more change, is that if the insurance premium, aggregate insurance premium with respect to a policy which is issued after 1st of April 2023, any sum received from such insurance will be liable to tax, excluding a situation where the sum is received on account of death. So that will obviously remain exempt, but otherwise it will get taxed. And any premium which is paid for such insurance, that will be eligible as a deduction against that income. LTCG exemption, obviously there are a lot of government felt that this benefit is being availed by HNIs, where they're obviously having long-term capital gains on account of sale of property or other long-term assets, and they're investing in properties and getting a exemption on 54 or 54F. Now that there was no cap with respect to exemption that can be claimed under section 54 or 54F. Now a cap has been introduced, proposed, that it will be restricted to 10 crore rupees. So beyond 10 crore rupees, no deduction will be eligible under 54 and 54F. There is also a change from a TCS perspective with respect to foreign remittance under LRS scheme other than medical education, which was TCS was at 5%. Now TCS has been increased from 5% to 20% with respect to LRS other than medical or education without any threshold limit, or for buying foreign tour packages. So that's it from my side. Over to you, Dwarak. Thank you.
Thanks, Tapan, for the detailed examination of the budget proposals. I thought we'll just end with a little bit of a summary in terms of what the industry expected, what were the broad expectations, and what finally came out in the budget. Obviously, one of the asks from the investor community was the need for stability in the taxing system. And there is definitely in this budget a resounding yes in response to that. The finance minister has not made any changes to the tax rate, no major changes to the law, no retrospective amendments, etc. So a very strong sign that stability is something that the government is focused on, and that is something that came out very strongly. Ease of doing business, I think there were several proposals which were put forth in the budget speech, which had to do with multiple laws, whether it was, with regard to the gift city, linking various other legislations, decriminalizing various proceedings under laws, etc. Definitely, I think a lot of things have been done there. But could there have been some more things done? And if you listen to some of the changes that Tapan was talking about, whether it has to do with the amendment in section 245, which allows the tax officer to withhold refund in circumstances, if it has to do with, say, the inventory valuation opportunity or option which is given to the assessing officer, would those really help in ease of doing business, or are they prone to misuse such that perhaps taxpayers may struggle because of those provisions? Reduced litigation compliance, the introduction of the 100 joint commissioners to handle small appeals is a fantastic development, and definitely it will speed up the process of litigation through the appellate courts, etc. I think the question, however, remains is what will happen on the ground? We have seen in the last year to 18 months, the process of search and surveys still continues. There are still aggressive high-pitched assessments which take place from the taxing authorities. So will the mindset of reduced litigation, which is the message coming from the top, will that really flow down? Or is it going to be a struggle? Because end of the day, taxes do account for a majority of the government's budgetary revenues. And therefore, will we see a continued focus on investigation, search, surveys, and assessments by the tax authorities, or will we see a reduced litigation? Similarly, could the government have done something in terms of speeding up the board for advance rulings? And I know last night there was a notification issued notifying the members of the bar. But is there something that the government could have done to introduce some certainty, speeding up the process of the bar, which has been in a limbo now for a long time? Boost for manufacturing, in my view, is a tough one. Here was really an opportunity for the government to do something big. Everyone has been talking about China plus one. China's reopening post-COVID has been disastrous, and again, it has created an opportunity for India. The 15% rate is definitely one of the most competitive in the world. But it comes with the rider that your operations have to start by March 2024. So could the government have considered a little bit of an extension in the timeline, especially considering the fact that labor reform is still stuck because we have not been able to clear the labor amendments, etc. Land reform is still stuck. In those circumstances, could an extension in the manufacturing rate have helped? Could the government have tinkered even with those provisions to not require a new company to be formed? Could it have been through an expansion of operations? Those are things I feel that the government missed out. Similarly, if you look at cooperatives, yes, 15% tax rate for cooperatives, but think of it in perspective. It says you have to set up between 1st of April of 2023 and 31st of March of 2024. Now, how practical is it for an organization to set up a cooperative and be ready and commence its manufacturing operations in that time? Manufacturing is not services. It requires heavy investment. So in 12 months, you have to commence those operations to claim that benefit. How viable is it? So I think the government certainly missed an opportunity here to show that India is that China plus one option. Innovation, entrepreneurship, again, I feel is a big missed opportunity. Yes, we spoke about startups and the 7 years to 10 years in respect of the losses, but the change in 56 to 7B is a big one. There is no clarification on ESOP taxation, which is one of the biggest issues for startups because their employees tend to be out of pocket at the exercise stage and not at the liquidation event. And that is stopping them from incentivizing talent. So that's a big one. There is still no guidelines or no notification issued by the government in respect of allowing Indian companies to list overseas before they list in India. So those were some of the things that would have really boosted innovation and entrepreneurship. Yes, they did help the MSMEs to some degree, but if you're looking at the startup ecosystem, I think they missed an opportunity. Global developments with Pillar 2 coming in and legislative process having started in many countries, there was an expectation that India would also give a path to Pillar 2. What that would have meant, and as most of us know, Pillar 2 basically provides for a global minimum tax rate of 15% for certain multinational companies above a threshold. And if that global minimum tax rate is not met, then there are different mechanisms through which a 15% rate can be used, whether by way of a top-up tax in the home country or by way of an income inclusion rule. And that again would have been a development that was an expected development that the government should have given clarity and a path in the budget. It need not have been in FY24. It could have been at a later date, but certainly a path to Pillar 2 adoption would have been important to give that signal to the global community. And finally, reduce tax burden. Definitely, yes, with the changes in tax rates that we spoke about. So overall, I think, yes, the budget has done many good things, has simplified and provided clarity, but perhaps could have taken a bit of a bet on certain of the other developments. So with that, I think we are at the end of our time. So Ridhima, I don't know if you have time for maybe one question.
We do have some good questions coming. Shall
Sure.
we? Yeah, great.
Yeah. So maybe I'll pick it up, Ridhima, if that's okay. I can just pick it up.
That would be fine. Perfect.
So sure. So Tapan, there's a couple of questions. One question says for remittance under the LRS for education or medical above 7 lakhs, does the 5% TCS remain intact? I think there is an exemption, right, for medical?
Yes, it remains intact. So for education where the remittance is out of loan that has been taken and which is beyond 7 lakh rupees, it is 0.5%. For medical, it is 5% and 7 lakh limit remains. So apart from those, there's no limit. So without any limit, it will go to 20% tax from 5%.
Yeah. The next question, Tapan, is what kind of appeals are likely to be shifted to the JC's jurisdiction? Only the new ones or also the past ones?
Interesting.
No, it basically says that even the past ones can also go. So they would basically decide which are the ones which can go from CIT appeal to JCIT. But of course, not the orders which are passed by JCIT or ACIT or any of the above rank or under their direction. So barring those, all other orders can go, but they would decide.
Interesting. So I have few more queries from other channels. Shall I? If you have 2 minutes more.
Yeah, maybe we'll take one more question, Riddhima.
Yeah, so one is the proposed amendment in section 43B, which is discussed, relating to sum payable to MSME. Will that demotivate entities to do business with MSMEs? What do you think?
So maybe I'll try to respond to that, Tapan, and you can add. I'm not sure that that is a demotivation for MSMEs. It is not a permanent denial of the deduction. All the government is doing is ensuring that, similar to other 43B items, that the deduction is available when the actual payment is made to the MSME, right? And there are, of course, certain timelines, etc., which are prescribed for payments to be made to MSMEs. And if you don't make it within those timelines, then obviously it will be allowed to you only on a payment basis. So I'm not sure that it is going to disincentivize companies from working with MSMEs.
Correct. Great. Thank you so much. That was a very useful session with you both. Thanks a lot.
Thank you. Thanks, Riddhima. Thanks, Tapan.
Thank you.